What's up, guys? In today's video, I'm going to explain exactly what whole life insurance is. So I'm going to talk about non-participate whole life insurance and participate whole life insurance, what's the difference between them, and how this can work. So with that, let's just get straight into it. Okay, I want to caveat here before I start the video. I will not be talking about when you should buy whole life insurance. Is whole life insurance right for you? I'll actually make another video about that. And if it's not already made, if it is made, it'll go here. I think it's there. But if it's not already made, I will be making that video. Is whole life insurance right for you? This video is gonna be more on just the basics of how whole life insurance works, the mechanics of it, the different features and details, not if it's right for your situation. So look out for that video if it's not already made already. Let's get into it. So whole life insurance, there's two different kinds of whole life insurance. There is non-participating, and then there is participating whole life insurance. Now, the easiest way you can think about it, whole life insurance is a form of permanent life insurance. I have another video talking about term life insurance. Term is just used to cover you for a specific time period, a short time period, maybe 10, 20, 30 years. I guess 30 years isn't that short if you think about it, but it's not permanent. It's not gonna last until your death, as long as you live to a long, ripe age. If you die suddenly, of course, then there's that. Now, there's two different kinds of permanent life insurance. There's whole life and there's universal life. I'm not talking about universal life in this video. I'll make another video about that. And again, if I've made it by now already, boom, it'll be somewhere up there. But this video, whole life insurance, participating and non-participating, let's talk about it. Let's talk about non-participating whole life insurance first, because it's easiest to understand and it's very simple. So let's get into it. So basically, easiest way that you can think about whole life insurance is instead of renting a house, which is what term life insurance is, you're now paying the mortgage on the house, okay? So you're paying it down. The premiums are gonna be substantially more than if it was term life insurance. You're paying it down, it's quite a big sum, but you have a payment period, okay? And that's the most recognizable feature of a whole life, is instead of just paying premiums forever, you have a set period that you pay it for. And during that time, if you pass away, the death benefit will get paid to your beneficiaries, just like with any other form of life insurance. However, the difference is, once you're done that payment period, you're done paying for the policy. So it's paid off, just like you would pay off your mortgage, and now the house is yours. You're paying off your life insurance, and now the life insurance is yours. And so some different terms that you can choose. So 10-year is quite common, 15-year. 20-year, I would say, is the most common. So you pay premiums for 20 years, and then after that 20 years, you stop paying the premiums, and you're good to go. You no longer pay them, but whenever you do pass away, your beneficiaries will receive that death benefit. Now, there's also life pay, which is exactly as it sounds. You just pay the premiums for life. It's a fixed premium. By the way, I should have said that. All the premiums are a fixed amount, so whether you choose 10, 15, 20, or life pay, it's a fixed premium. It doesn't keep going up like term insurance keeps going up, so it's very cheap in the beginning, and then as you get older, it gets more expensive. This is a fixed amount. It's gonna stay the exact same until you're done paying for it. Now, you've probably heard before that permanent life insurance and whole life insurance has this cash surrender value. Okay, so what is cash surrender value? In the easiest way to try and explain cash surrender value of a life insurance policy, because a lot of questions are like, well, how do I access that? Is that cash? Is it extra when I pass away? Like how does that work? Like how do I use these funds? Easiest way that I explain to my clients how you can think about cash surrender value is it's like the equity within your home. So just like you would be paying down a mortgage, you'd be building equity within your home. And now it's not as simple to access the equity in your home. It's not like a bank account, you can't just take it out. That's the exact same as a cash surrender value. So there's a few different things that you can do with this cash surrender value, which grows over time within a whole life policy, okay? So some of the things that you can do with it is you can take a loan against it. So there's a few different ways you can do what's called a collateral loan. So that's where you would assign this policy to a third-party lending institution, and then they would give you a loan. So you'd pay interest on that loan just like any other loan. You can kind of compare that to like a home equity line of credit. Just like you would pay interest on a home equity line of credit, you're paying interest on this third-party collateral loan on your life insurance policy. The second kind of loan that you can get on your policy is what's known as a policy loan. Now, this isn't from a third-party lending institution. This is actually directly from the insurance company. Now, the difference with this is, number one, now you're going to be paying interest to the insurance company and not to the bank. And number two, policy loans are taxed differently than collateral loans. Policy loans are actually can be taxable in the hands of the recipient. So collateral loans are tax-free, policy loans can be taxable. Now you're probably thinking, well, why would I ever take a policy loan then if I can take a third-party collateral loan? Well, it's not so simple as just going down to the bank and asking for a loan. There's a lot of requirements that need to be met in order to secure this loan. So if you have an advisor that says, hey, no worries, we can take this loan, there's no problem, I don't want to say they're lying, but there's a lot of complications on trying to secure a loan against a life insurance policy. And maybe I'll make another video of that because that's a huge subject in and of itself. Okay, so I will actually, and if it's not, it's made already, it'll be somewhere, and if it's not, I'll make it, don't worry about that. The third thing that you can do with the cash surrender value, is if you cancel your policy, the insurance company will write you a check for that amount and they will send it to you. There's some taxes that can be applicable, or will be applicable, I should say, but they will write you a check for the cash surrender value and they will give it to you if you surrender your policy. And surrender your policy means you cancel your policy. So it can be compared to owning a home where you can't just access that equity. You can only get it if you take a loan against it or if you sell your home. It's kind of the same with this insurance policy. You can only really get it if you take some kind of loan or if you surrender your policy and they have to pay it out to you. By the way, guys, if you guys are interested in getting instant life insurance quotes, you can visit Affinity Life, and I will put that in the description so you can view quotes online and apply 100% online. Click the link in the description below and you can learn a little bit more from that. Okay, so everything that I just explained so far has been non-participating life insurance. Now, participating life insurance is the exact same with all of those features that I previously described, but there's an extra component, and the extra component is now you are participating in the growth and the returns from the insurance company. So participating insurance is more expensive than non-participating whole life insurance, but you get some extra benefits. So let's talk about these benefits. Basically, in a nutshell, how participating whole life insurance works is you're paying a large premium to the insurance company. They're taking their portion that they need to cover for the cost of insurance, and then they're taking the other portion and they're investing it. And then the insurance company is making returns on their investments, they're earning interest, they're looking at the mortality rates of the entire company, and now you are participating in those returns of the insurance company. So every year, they're gonna declare a dividend, and they're gonna say, we earned 5%, we earned 10%, and we're gonna return this back to our participating policyholders. And if you buy participating whole life insurance, you become a participating policyholder. So there's 5 different ways that you can choose to receive this dividend, and you select this option when you apply for your policy at the very beginning. And depending on which one you pick, it can be tax exempt and tax free, but some of them are taxable depending on what you pick, and we'll get into those. So there's 5 of them. You get to pick at the beginning. Let's start with number 1. The first dividend option that you can pick is something known as paid-up additions. So paid-up additions is essentially whatever your dividend in that year is, the insurance company will take that and they'll purchase a one-time amount of paid up for life insurance on your life. So what this allows you to do is maybe when you started the policy, your death benefit was $100,000. Every single year, if you choose this option, your death benefit is gonna increase. So in the first year, maybe it was 100, and then in year 2, it was 101,000, then maybe 103, and then 107, then 111, and so on and so forth. So your death benefit is essentially increasing with time. Second option is actually kind of interesting. So it's called enhanced insurance. Essentially, what that is, it's like a combination of term insurance and paid-up additions, but in a nutshell, it's a way to lower the cost of your whole life permanent insurance for the same amount. So they're gonna supplement the death benefit in the early years with term insurance. So they're gonna use that dividend to buy term insurance to cover that portion. And then in later years, they're gonna convert that essentially to paid-up additions. So I know that might sound a little bit complicated. All you need to know, it's similar to paid-up additions. The difference is it's usually much cheaper, okay? You're not gonna get the same growth as paid-up additions, but you're gonna get the same benefit for a lower cost. The third option you can pick is premium reduction. That's pretty straightforward. If your premium's $10,000 a year and the dividend declared, let's say, is $3,000, they're gonna take that right off the top, so you only owe the insurance company $7,000. That's a hypothetical example. That's easy to understand. The fourth option you can pick is something known as on deposit, and that's essentially where they're gonna take that amount and they're gonna put it within a savings account, and they'll manage that, and you'll earn interest on that account. And then the fifth option, which is easiest to understand, is they'll just write you a check So they'll cash it out each year and they'll write a check. So the last two options there, cash on hand or on deposit, and the pay you a check, those two options, those are both taxable options. So obviously you're receiving that benefit in a cash form and you're gonna be paying taxes on it. So maybe not. Those options, I'll be honest, I've never sold them as an advisor before. The two most common ones that most people pick are the paid up additions and the enhanced insurance. Enhanced insurance especially, it's just a cheaper way to get into whole life insurance with the potential upside of that paid up additions. So yeah, it is what it is. Other than that, I'm not sure that there's too much else that I can think of to throw in this video. Obviously, I mentioned that I would make a universal life video as well as who should purchase whole life and who is it right for. If you have any questions, please do drop them in the comments below and I'd love to answer them. And if you guys are enjoying this content, all I ask is just give it a thumbs up. And with that, I will see you guys in the next one. So before I get into the dividend options that you can choose, I should say all of them to the most part. This is what happens when the camera dies and you're in a flow and you're making a video and then you lose your train of thought and you try to get it back. It's gone. It's gone. Ugh. And I was on a good flow. I feel like I was on a good momentum, you know? Okay. Your death benefit is increasing by the amount that the dividend is. It is so hard to get back into a video when it's broken up like this. Okay, so the second kind is actually kind of interesting. It's called enhanced insurance or enhanced. Damn it!